The live price for Pagaya Technologies Ltd, under the ticker PGY on the Nasdaq, is currently $28.10 per share, showing a substantial intraday jump of plus 3.64 or 14.91% today, Monday, November 10th, 2025. This significant single-day surge immediately exceeds the common market expectation that a financial technology or fintech company focused on consumer lending would be struggling under the pressure of persistently higher interest rates and a tightening credit environment. The common narrative suggests that as macroeconomic uncertainty increases, lenders become more risk-averse, which should choke off the supply of credit flowing through platforms like Pagaya's, thereby constricting their fee-based revenue model. However, the reality, as signaled by today's explosive stock movement, is far more nuanced, driven by two simultaneous powerful forces: a major earnings beat, and a successful demonstration of counter-cyclical resilience that many investors simply hadn't priced in. The immediate spark for this movement is the company's Q3 2025 earnings release this morning, which delivered a record performance across key metrics, especially a $23 million GAAP net income, up $90 million year-over-year, and adjusted EBITDA of $107 million, a 91% year-over-year increase, all while raising full-year guidance for the third consecutive quarter. This strong result flies directly in the face of the generalized weakness we've seen in other high-growth, high-multiple names. Investors widely expected a decent quarter, perhaps one that showed stability, but not this level of accelerating profitability and operational efficiency. The market narrative, the expectation, is that AI-driven lending platforms are unproven in a sustained period of high interest rates and increased consumer strain. The reality, delivered this morning, is that Pagaya's proprietary AI and machine learning underwriting engine seems to be acting as a genuine differentiator, enabling their lending partners to identify pockets of lower-risk borrowers within an overall riskier pool, thus maintaining volume and, crucially, improving fee margins. The general belief about a stock like PGY is often centered on its status as a high-beta growth name that thrives primarily when credit is cheap and abundant, a play on economic expansion. Its massive stock moves, like the one we are seeing today, and the significant volatility demonstrated by its high 60-month beta reinforce this view of it being an all-or-nothing momentum trade, perhaps more suited to the risk tolerance of those practicing self-investing through platforms like Robinhood or SoFi Invest, rather than the measured strategy typically associated with a Schwab Intelligent Portfolios or a Standard Fidelity account. But this is the point where we need to challenge that initial assessment. The deeper take is that Pagaya isn't just a volume play, it's a technology company that provides a crucial service: risk management in an uncertain environment. In a low-rate environment, every lender has a viable business. In a high-rate, higher default environment, lenders need better tools to separate good credit from bad, and that is precisely the service Pagaya's AI-powered network offers to its partners, which include major banks and financial institutions. The market is waking up to the fact that their fee-based business model, which essentially charges for its AI's predictive power, can become more valuable when economic conditions worsen, provided its models hold up. This shift in perception, from growth at any cost to disciplined, profitable growth, is what is fundamentally driving the volume and the price movement today. Looking at the recent stock movement in detail, the trading volume this morning is absolutely critical. We've seen volume spike well above the 30-day average, which tells us that this move is not just a few small traders reacting to a headline, it's significant institutional capital flowing in. This is further validated by the institutional ownership data, which, even before this latest surge, showed hundreds of institutional owners holding tens of millions of shares, with major asset managers among the largest shareholders. The short interest for Pagaya, which historically has been notable, is likely getting squeezed today as the positive earnings news forces bearish bets to cover their positions, further compounding the upward pressure. This phenomenon is a classic example of what happens when a widely held negative expectation, fintech weakness in a tight credit market, is violently refuted by the reality of accelerating profitability. In addition to the earnings figures, the details of the company's expansion are equally compelling for institutional buyers. The recently announced $500 million auto forward flow agreement with Castlelake following the expansion of the revolving credit facility to $132 million at a lower interest rate confirms strong capital market validation for their assets. This is a critical signal for any online investment watcher to recognize. Institutional investors, the Wall Street side of Pagaya's business model, are showing high confidence in the long-term quality of the loans underwritten by Pagaya's AI, even when the retail investment help community might still view the name as purely speculative. This provides a strong underpinning for the long-term viability of their capital-light fee-based model, which is a major positive compared to balance sheet-heavy lenders. The diversification into the auto and point-of-sale verticals with a second AAA-rated $300 million POS revolving ABS transaction shows that their technology is scalable across different asset classes, not just the personal loan space they started in. This asset diversification mitigates cyclical risk, making the PGY stock a more robust play than its high beta label suggests. To understand Pagaya's business model in a foundational way, it's worth stepping back from the daily stock ticker. Pagaya is essentially a financial technology infrastructure company that operates a two-sided network. On one side are its lending partners, banks, credit unions, and fintechs, who use Pagaya's AI to analyze a vast array of alternative data to score borrowers who might otherwise be declined by traditional credit models. This expands their addressable market. On the other side are institutional investors who purchase the asset-backed securities of the loans underwritten by Pagaya's AI. Pagaya's income is primarily generated through fees for facilitating these transactions, keeping its balance sheet lean. Its AI engine, which has evaluated trillions of dollars in applications since inception, is the central product. Earlier reports indicated that it was on a consistent trajectory, but a key concern from late 2024 and early 2025 was the potential for credit impairments, particularly in older loan vintages, which put pressure on the stock. That noise has largely been drowned out by the Q3 performance, which specifically highlighted prudent underwriting and improved economics in the personal loan and auto verticals, suggesting the model is adjusting effectively to the current economic environment. This is a subtle yet significant detail. The system's ability to learn and adjust during a challenging cycle is the true test of its technological advantage, and the record GAAP net income provides strong evidence that this adaptation is happening successfully. For those using platforms like Interactive Brokers Trading, which provides granular data on institutional trading, the shift in net long/short positioning around PGY in the next few weeks will be crucial to track, as it will reflect a changing sentiment among sophisticated traders. The comparison to other large technology-enabled financial services is interesting. For example, while Apple stock and Tesla stock are fundamentally different businesses, their recent forays into financial products underscore the increasing intersection of tech and finance, a trend Pagaya is capitalizing from the B2B side. Shifting into the future outlook, the tension between expectation and reality continues to define the PGY stock trajectory. The expectation is that the raised full-year guidance for 2025, which now projects total revenue between $1.3 and $1.325 billion and adjusted EBITDA up to $382 million, sets an incredibly high bar for Q4 2025 and into 2026. The reality is that the company's recent partnerships, forward flow agreements, and platform expansion provide clear, executable catalysts to meet and potentially exceed these new targets. The narrowing of the network volume guidance from an earlier range of up to $11.5 billion down to a maximum of $10.75 billion is not a sign of weakness. It's a strategic signal of prioritizing profitable, high-quality volume over simply chasing top-line numbers, a clear sign of management discipline that institutional investors love to see. This focus on higher-margin, quality loans is a key risk mitigation strategy. The financial strength of Pagaya is further buttressed by its strong liquidity position, which supports its operations and planned growth. The continued scaling of their core AI platform is the fundamental driver of margin expansion due to operating leverage, a concept well understood by users of Fidelity ETFs and Fidelity mutual funds who look for companies that can grow revenue faster than costs. The firm's ongoing commitment to improving its unit economics is evident in its focus on revenue from fees less production costs, or FRLPC, which saw a significant jump year over year. Potential positive scenarios include the successful execution of their expansion into the point-of-sale vertical, leveraging their AAA-rated securitization shelf to rapidly scale that business and capture market share from competitors. The fact that they have already secured over $1 billion in additional funding capacity through an inaugural POSH securitization in May 2025